Hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Thursday, October 3rd, 2024. So we'll just jump right into it on the daily chart here. And this is the extended hours chart. So it shows the overnight session, the Globex, and you can really use either chart. Doesn't really matter, but I tend to look at the overnight session just because there's less gaps. But either way we look at this, here was yesterday, bull reversal bar, but we have a micro channel. If you look closely, we have trending highs. So since this bar, every high is at or below the high of the prior bar. So it's a bear micro channel. And that increased the chances that if we went above yesterday's high, there would be sellers above. Now I wasn't sure if we'd rally above the high and find sellers up here, but I did suspect overall we're in a trading range and there would be sellers. Plus, bulls are discouraged from buying here. It's not a very strong signal bar after a relatively big bar. And if you're buying on a stop above this bar, you're buying in the middle of the tight trading range. And then as far as selling below this bar, I would not. Tight bull channel, first test of the moving average, and the signal bar is a bull reversal bar, probably buyers below the low of yesterday. For today, the open is typically a good indication of what the day ahead will look like. And by the way, you can see on this chart I've delayed data so you can see the time and you can see that the market, it looks like the market has not closed, but of course it has. But anyway, look at the first two bars of the day. We have a gap down, bull trend bar, and then a bear trend bar. So right off the bat, lots of overlap, big up, big down, big confusion. And that gives traders a warning that today will likely be a trading range day, probably a limit order market, and whenever anything is bullish, traders look to sell, and whenever anything is bearish, traders look to buy. I thought bar 1 was strong enough to get its own second leg, but there's something to remember. When the market is in a trading range, there's a couple of things to always remember. The first, you've heard Al say it, buy low, sell high, and scalp. And secondly, whenever you get a breakout in a trading range, you're expecting deep pullbacks and delayed second legs. And today we had great examples of that. So today, big up, big down on the open. So good looking bear trend bar, but almost completely overlapping the prior bar. More likely buyers below bar 1 looking for a second leg up. Now the second leg was a little surprising. It's a big breakout, but look to the left. Here's the context. And we have trading range, price action to the left, and this could easily be a vacuum test of resistance at the top of a trading range. Let me just add yesterday's high and yesterday's low. So the blue lines represent the high of yesterday and the low of yesterday. So the market rallied up on bar 8 and a little bit on 9. We came close to yesterday's high, but then we had a violent reversal down. But remember what I just said about deep pullbacks and delayed second legs. So yes, strong enough bull breakout for a second leg, but traders don't want to buy at the top of a trading range. Traders are buying low and selling high, and they're scalping. So what do? Well, let's look to the left. Bar 4, not a very strong buy signal bar. 3-bar micro channel, should get a second leg down, but then we got a huge reversal up. Any trader who bought above 4, bought above 5, they had great follow through, and that trapped a lot of traders down here. and that creates support. So strong enough bull breakout for a second leg, but no one wants to buy up here, and that leads to an imbalance. Bulls who bought down here are selling, and bears, knowing we're at the top of a trading range and knowing this might just be a buy vacuum test of resistance, are also selling. So we get a huge bear bar, but look where we reversed. Right at this stop order, we went a little bit below it, but there's support here, and sure enough, the bulls got a second leg from the low of 9 to the high of 10. And the process repeats over and over, so the same thing can be said about bar 9. Strong enough bar on bar 9 for a second leg down, but nobody wants to sell when bar 9 is on its low. We're at the bottom of a trading range, we're at support, and nobody wants to sell the close in the middle of the range. So what do? Set limit orders to sell a breakout point. The market tests the breakout point, bad stop order sell below bar 8. We test it, go a little bit above it. Sure enough, we get a second leg down. Bars 11 and 12, bear breakout and follow through, but maybe 2 legs down, low in a trading range. Nobody wants to sell low. Plus, and this gets a little bit confusing, and trading ranges are confusing. Whenever you are confused and not sure, you know the market's in a trading range. And what can be confusing is how markets are fractal and patterns can be nested. So bull breakout, deep pullback, second leg. However, this may not be enough of a second leg. It's common to see breakouts get brief second legs before getting more symmetrical second legs. So the reality is, this may have all been just one breakout. This could all be a complex pullback. We fall below the breakout, and then this rally was the second leg for this breakout. So breakout followed through, 11-12, but bad context. Buyers below. Good bar for the bulls, 13, but remember, buy low, sell high, and scalp. 13 is a good bar, but if you're going to buy above 13, you're buying after a 4-bar bear micro channel in the middle of a trading range. It's not ideal. Traders would rather buy below bar 13, expecting 13 to get its own second leg, deep pullback, and then a delayed second leg. 15, the process repeats again. You could say it's all one leg from 9 to 15, or 1 pullback, 2 pullback, 3 legs down, but tight enough channel to be a breakout. The first reversal should fail. Sure enough, sellers above, and the bears get a second leg down. But now we have 18, 19. Another bear breakout and follow through. But think about the context. What's bar 18 actually breaking out of? It's overlapping all the bars to the left. It's really only breaking below bar 17, and the follow-through bar is weak. It's much smaller than bar 18, and it's a trading range bar. Plus, it's a late leg, probably at least a third leg down, if not a fourth leg down, low in the range. After 3 pushes, you expect 10 bars and 2 legs, sideways to up. We're low in the range, the context makes sense to buy. Then we get a bull breakout. Bar 20. 21 pulled back, but you can see there's disappointed traders buying back shorts down here, trapped on bar 20, and 20 was strong enough for a second leg, and we got a second leg. But the reality is, we then got a 5-bar bull micro channel up to bar 23, and this entire move is one breakout and strong enough for its own second leg. 23 is a weak sell setup. You're low in the range. It's a bull trend bar, probably buyers below, and there were, for a second leg up. And we can think about maybe leg 1, leg 2 measured moves. There's leg 1. There's leg 2. Buy vacuum on bar 27 to the leg 2 measured move. Consecutive buy climaxes, 20, 23, 25, 27, but tight bull channel, only want to look to buy. But then up here, we get back to this price, the low of bar 8. We know it's resistance, just look to the left. The last time the market was here, we sold off, we get disappointed, bulls up here trapped traders, and we got more to the downside. So when we retest resistance, we expect the resistance to hold. We're high in the range, we expect sellers high. Consecutive buy climaxes, the bulls are not as in control as they could be. This looks more like a leg in a trading range. If you look to the left, there's a lot of overlap. It probably is a bull leg in a trading range. And what do we expect after bull legs in trading ranges? We expect bear legs in trading ranges. So consecutive buy climaxes, and you can call it a wedge up here, 27, 29, 35. And when you get bar 36, the market might be always in short because of context with the consecutive buy climaxes, the 3 pushes up, and high in the trading range. You get a bear bar closing near its low. If you're long, you can get out. Always in bulls, get out below 36, and bears can sell, taking a chance we start to swing down. This does not happen every time in a trading range. Traders sell below 36, good entry bar 37, more follow through 38. We have a gap. There's a space between the low of 36 and the high of 38. And that's a sign of strength. 39, acceleration. Do you sell the close of 39? It's not ideal because it's a big bar, and typically big bars in trading ranges have bad follow through. Just look at every big trend bar in this part of the day, and you'll see what I'm talking about. So really not ideal to sell the close 39. If you do, you know your premise is momentum. You need the bears to keep control over price and time, and you want the market to keep going. And in this case, it worked out for the bears who sold the close. But at some point, you always have to be thinking about the trader's equation. You can sell, betting that there's high probability, but when you look to the left, the probability is not all that high. If the bears have momentum, that's good, but at what point do you conclude that the market is unlikely to go 1 times your risk? Now you're short on the close of 40, stop up here, your 1-to-1 target's all the way down here. And that would require breakout of the trading range, and 80% of trading range breakouts fail, so not ideal. And thinking through that 1-to-1 ratio, the trader's equation, will help you with scalping in trading ranges. Because whenever the market gives you a profit in a trading range, you have to take it because it can easily reverse. And this is such a common thing to see. You're trading on a day like this and you buy above bar 5. You say maybe it's 3 pushes down, you look to the left, and maybe it's low in a trading range overall. And all of a sudden, 3 bars later, you're all the way up here. And you're thinking, okay, stop below 5, bull breakout. Al says there's a 60% chance we get a measured move. I'll swing this trade and go for a target up here. And that's great, but you're forgetting about probability. And you're forgetting that the market is in a trading range and you should be scalping and selling high. And so you buy above 5 and get this follow through only to be back at your entry price on bar 9, 1 bar later. And all of a sudden you're up, pick a number. You're up $100 on a trade, and then all of a sudden you're down $50 on the trade. And that's so common in trading ranges, and that's why it's so important to scalp. Over here, this is an example of breakouts getting a brief second leg before the real second leg. This example isn't great because the bears never really got a legitimate second leg. The minimum requirement the bears wanted for the second leg was another breakout below, 1 tick below the low 43. So bear breakout, finally got a pullback, but the odds are 41, any trade. If the market goes above 41, the odds are the reversal will be minor. You can see traders sold, and we got a brief second leg down, leg 1, pullback, leg 2. But this second leg is not symmetrical. Now the overall problem with it is that it may have been a second leg trap, leg 1, pullback, leg 2. Look at a 15-minute chart. Here's today over here. The market's been in a trading range, and it's big down, big up, big down, big up. We get a sell-off, deep pullback, and then a really strong sell-off, but might be leg 2, might even be leg 3. So you're wondering, how can such a strong sell-off just get bad follow-through and reverse like that? And you always have to be thinking about the context, and it helps to look at higher time frame charts, especially when the 5-minute chart looks like this. Parabolic wedge to the moving average, 1, 2, 3. Strong enough breakout for buyers below and a second leg, but again, a breakout in a trading range. So what's the expectation? Deep pullback and delayed second leg. Sure enough, we look at bar 46. Bad stop order signal bar. If a trader bought above 46, they made maybe 3 times the bar range on the entry bar. And that trapped a lot of traders selling above here, expecting this tight channel to continue. And so we get the bull breakout, 1, 2, 3. Expectation for a parabolic wedge is a minor reversal and then another leg in the direction of the wedge. Here's our minor reversal. It's a deep pullback, testing the bad stop order, and then the bulls get a second leg. So now at this point we have 2 legs up, 1, pullback, 2. And look where we are. After the sell-off, it's around a 50% pullback. There's resistance here. You can see the market had a hard time getting above that 50% pullback. After 2 legs up, you can even call it 3 legs, 1, 2, 3. When the third push does not go above the second push, it's a truncated wedge. But it doesn't matter what you call it. You can see the market's attempting to rally and failing at a key resistance area. This should get a second leg. So bears selling here are expecting a second leg, remember, to go 1 tick below 43. The market went sideways for so long in here, and we also had a triangle. You could look at it this way. In general, whenever you get a breakout of a triangle, there's a 50% chance the breakout fails and reverses. Look at this bear breakout. And there's a couple things wrong with it, but just ask yourself, is this a strong bear breakout? If you go back to the video course, or if you think about, you can read it in the books when Al talks about characteristics in a strong breakout. You'll see things like the bars are uniform in size. There's not much overlap. In this case, a bear breakout. Bars are closing on or near their lows. We're getting micro gaps. And we're just, look at the context. There's not a lot going for this bear breakout. And even though it's a micro channel, we're getting trending highs and trending lows, really trending everything for the bears. Open, high, low, close. Good for the bears. Probably sellers above for a second leg down. But the overall context, you have a disappointing rally after this breakout. The bulls control price and time for a lot of bars, maybe 15 bars up. And then you get a tight trading range. And in general, the breakout direction is 50-50. Weak breakout, and maybe you've seen my leg counting video, and we talk about implied legs and implied pullbacks, and a trader can count 3 legs down here. We sold off on 67, rallied. Now at that point, I thought we would go a little bit lower, because look at bar 67. Not a lot of overlap with the prior bar. What this could be is a breakout pullback, and this might actually be a sell to close bar, at least for a scalp. But then look at the follow through. More selling, but then more buying into the close, more selling, more buying into the close. If it's a strong bear breakout, why are traders buying into the closes of the bars? So that's suspicious. And then look to the left. Remember that stop order I mentioned? Bar 46 high, 51 tested it, 69 tested 51. That may have been a perfect double bottom. It was close. We went one tick below 51. So you can see we're getting consecutive sell climaxes and a double bottom. It's also nested. You can count 3 legs like this. 1, 2, 3. Overshoot of the channel line. There are a couple of reasons to expect support in this area. Plus, look at the big picture. Bear trend, trend line break, possible higher low, major trend reversal. Bulls will buy here, hoping we get a rally. And that's not unreasonable. You think about the day as a whole. Remember back on the open, big up, big down. Over here, big up, big down. Lots of energy. Again, big up, big down. So we're big down, we're low in the range. We could easily have a big up. Trap traders over here. You have bulls who bought below 35. It's a bad stop order sell. Tight bull channel. If you do something reasonable, there's a 60% chance you can exit at your original entry. There's an 80% chance you can avoid a loss by scaling in lower and exiting at the cost average of your 2 entries. So maybe it depends on what you do here. Maybe you buy below 35, buy more above 44, look to exit at the midpoint. Or maybe you bought above 46, this bar would have gotten you out. But in either case, bulls who bought up here were trapped. And typically, gaps in trading ranges close. And this is clearly a trading range. You can argue it's a bear channel. It's a broad bear channel. We're getting lower highs, lower lows. But when the channel is this broad, you trade it like a trading range. So over here, bulls hoping for a higher low major trend reversal. But even in the best major trend reversal setups, only 40% result in major reversals. 60% of the time, you get a small profit or a small loss. And the market continues sideways or continues to the downside in this case. And we got some buying into the end of the day. But overall, on a trading range day, the open of the day is going to be a magnet. Bulls and bears fighting over the direction of the body of the bar, the close. You can see we're slightly bullish, closing just above the open today. But big tail above, big tail below, not a very strong bar for the bulls. Plus, look at the blue lines. It's an inside day. We never broke out above yesterday's high or yesterday's low. For stop orders today, you could buy above bar 5, gap down, second leg, and then using context to the left, if you see bar 4 as a spike, pull back, channels evolve into trading ranges, and the start of the channel typically becomes support, and that's where we're testing over here. So I thought that was a reasonable buy setup. Once you get big up, big down, you can see stop orders are getting chewed up, and there's nothing for stop order traders to do through here. And really most of the day was not ideal for stop order traders. Maybe it's 3 legs down, you can buy above 21 or 20, but really not ideal. Buying in the middle of this range, just below the EMA, which has been resistance up to this point. I thought bar 36 was a reasonable stop order sell. You're high in the range, consecutive buy climaxes, maybe a wedge. And always in bulls, have to get out below 36. Good follow through, always in short, and then just exit when there's a reason to get out. Do you have to get out above 41? I don't think so. Do you have to get out above 44? I would, and that's sort of a default exit. And I learned this from Al. Whenever you have consecutive climaxes. It's a parabolic move, unsustainable. You look to the left, the market's in a trading range. You're getting far below the average price. And then suddenly you start getting overlapping bars and then a bull bar closing above its midpoint. Usually it's just better to exit shorts above the bar, closing above its midpoint, and look for the next trade. Stop orders through here, not ideal. 50, bear bar, closing on its low. You can call it a low 3, low 145, low 248, and then low 350. But tight bull channel. I mentioned it's a parabolic wedge, probably a minor reversal, and then more to the upside. So I don't know, maybe there's a stop order scalp there. But through here, the market became really tight, lots of overlap. Not good for stop order trading. There are traders taking stop order trades, Even in here, a trader might buy hoping for the upside breakout, but when they get disappointing follow through, they'll just exit. That's what Brad calls fishing. Maybe you sell below 66, maybe you hold after 67, but start getting a lot of overlap and buying into the closes. Not the ideal follow through that you wanted. And again, you think about the fact that it's a triangle. We could easily come back to the apex of the triangle, and we could also rally straight above it. Maybe you buy above 70, taking a chance. It's a higher low, major trend reversal. Maybe you buy above 73, maybe 76. You're buying high in the range, you need momentum. But it's so late in the day, maybe not worth it. Then where do we go tomorrow? Here's the daily chart again. And it's a trading range, and there's lots of overlap. I mentioned today was an inside bar. It's an inside day. So it's obviously a trading range, as we know from looking at the 5-minute chart. There's a lot of overlap, and it's a bad idea for traders to hope for a breakout. Better to bet that breakouts will fail. So I suspect we'll have buyers below today's low and sellers above today's high. But because of the price action we've had over the past few days, here's the 15-minute chart. And you can tell the market is in a trading range, and I expect more of the same because markets have inertia. All right, that's all the time I have for today. Thanks, everybody, and I hope everyone has a good night.